Good day, folks. This is a discussion on how to apply the assumptions to your case study. And I'm going to go back and look at steel dynamics. Now, just as many of you, the updated final year-end numbers have come out, and it's dated 22 March. So I've had to go back in and adjust my numbers so that I have the most current numbers. I also went through the investor slide deck to make sure that I was current. So here's what we're going to do. We're going to go right over here, and I'm going to just go back briefly and talk about, let's go back here is our common size, and here is our trend, our summarized balance sheet. I put an average in there just so that I have some sense for there. Not required. But the important thing is I have this down here. Now, this income is my jump-off point. And as many of you, we can see that there was a fair decline between 2019 and 2020. But we're going to continue to focus on the margins, and we're going to focus on the common size, because that's telling us the relationship between the expense and the revenue. So that's the first thing I did. I then reviewed my sales analysis, and I checked to make sure I had it all right so that I know what the business segment is. Then I further broke it down into a rate volume. So then I move into my assumptions. Now, what I did is I needed to create one for every year, because the recovery is going to take a period of time. First, we're going to rebound to where we were in 2019. Okay, that's the first step, is getting there. Then, where do we continue the growth from the 2019 level? So you got to say, when do you think we'll go back to this 19 level? Okay, 19, 18. Okay, whatever it is for your company. So that is a key question as we go through the assumptions. So I have an assumption for each year. Now, if you build these all based on formulas, they'll work pretty fast. So the first thing I did is for 21 is I made some broad assumptions of what the GDP is, unemployment, inflation, and for this business, it's what is going to happen with infrastructure and building. If you've got a retailer, you might want to clearly look at what consumer spending would be. If you're an airline, what capacity are you going to use? So you always want to take it back to which is the key metric that you can use going forward. So I created these, BEAR, BAU, and BULL. Those are going to guide me at the high level as I break it down. Now, as I break it down, I am going to start with, I'm going to base it off my 2020 numbers. Okay, so I've made these assumptions, and that steel ops is going to be, let me just put, I'm going to, start all over. Okay, with the assumptions, I made my broad economic assumptions. Then I'm breaking it down. So I'm looking at it by each of the business lines, and I'm increasing this off of the 2020 base. And as I move forward, I'm basing the 21 growth off the 20 base. Okay? So essentially I interpreted these numbers here into what did I think total revenue will grow in these aspects of their business. Okay? But then I went one step deeper and I broke it into the rate and the volume, so that as we're going forward, I can assume they produce more in what they're going to sell it for. Okay, so these are things that I can manipulate, and I think when we go to the next step of doing the valuation or doing the forecasting, we're going to find some very interesting things that we may have to go back and adjust this. So I came out with the annual growth in tons, price per ton, increase in revenue. There's the 2%, which is the 2% up here. And I realized there's differences in their business. So some businesses are going to grow faster than others and have upside potential. So I broke it first down into steel ops, then I broke it down into metals, then into steel fabrication, and then other and intercompany, I left at a real high level. So you could do a very similar thing depending on the nature of your business. If you're doing FedEx, you can break it by business line, and that is also in packages or tons. So I go through metals, I go through steel fab, and that, when I add it up, is my base sales. Okay? This is what it is, assuming no strategic initiatives. Okay? But they have two of them. One, they have in Sinton, Texas, they have a flat roll mill. They expect it to come online in the summer, late summer 2021, and have a capacity of 3 million tons. So what I did is I made an assumption here that in the bear case, it'll only produce 5% of its capacity. Then I built it 10%, and then I build it at 15. Now, this is an assumption that it's not coming on until half the year is done. And I made the assumption that the revenue per ton is going to be same that I'm using up here. So there's a level of consistency. But if I change one of these numbers here, it'll flow through the entire estimate. So that's the strategy there. The second strategy they're working on is 2 coating lines. Cost is going to be $225 million, online mid-22. So I'm not going to plan any increase as a result of the strategy number 2. Okay? And when I add them up, this gives me my forecasted revenue, which will go directly to my forecast for each of those cases. I then went through all of the lines on my common side, on my summary income statement, and I assumed certain percentages of sales. And this was based on the historical pattern. So if we come back here and we see the percentages, you'll see that I essentially used what the average had been. Amortization of intangibles, I held flat. Now, a notation on the tax rate, and we know it's going to change, and as I discussed in the previous lecture, but I am making an assumption now that it doesn't change until 22. I may be right, I may be wrong, but that's my assumption. Okay? Now, that takes care of 21, and I'm going to now move into 22. Now, where we're seeing, okay, as I move into 22, I'm making another series of assumptions. Remember, each year is different. But I'm also planning in here is that the infrastructure bill will get passed. But when you think of projects, by the time they're designed, the steel is ordered, produced, and delivered, it's going to take a couple of years to really get the impact of the infrastructure project through the system. So what I did, I note that. The other thing I did is I did an increase off of 21. Not 19, not 20, but off of 21. And I use different numbers as I'm assuming the recovery in this is going to lag the rest of the recovery. And I went through basically the same thing I did before. I changed the amount of how much is going to come out of the mill, the new mill, and then I'm making an assumption of what percentage am I putting in these new lines that are coming on midway 22, how much they'll put in. So I get a total forecasted revenue. Okay? And then I work through the same thing below. I move then into 23 and 24, but you notice I believe things are going to be slowing down. So I'm not going to see the growth. So when you want to go through this, you got to do it by year, but if you build formulas, you can go back and change it fairly easy. So these numbers here are what's going to go to the appropriate forecast page. We'll go through that when we move on to the next step. I suggest that you do this first before you do anything, and then send me them. Let's look at them. Let's talk at them. It'll take a minute. And then that way you can be reasonably assured that as you move forward, it's going to be pretty good. So if you got any questions, do let me know.